Everybody, Uneducated Economist here. So I came across a few articles. I'm just going to kind of chat here just for a few minutes before the people start coming into the live stream. But I thought I would talk about the neutral interest rate again. This is something that we had covered a few days ago, and then I started seeing a lot of articles pouring out about it. And so when I see all these articles coming out about this neutral interest rate, and I see so many people talking so differently about it. Like you got one person saying like it's like 4%, you got another person saying that it hasn't moved. It makes it very difficult to understand what it is that the monetary policy is going into the future if nobody knows exactly where this neutral interest rate is. All right, good morning everybody. As you come into the live stream, go ahead and hit that like button like you already are. Oh my gosh, we got one person watching and 5 likes. I love it. So we're going to talk a little bit more about the neutral interest rate. I left a few articles down in the description. And really, this neutral interest rate is probably one of the most confusing things to look at because really there is no place to go to see what the neutral interest rate is. Like, you can't pull up a chart. There is no exact knowing. In fact, it takes time to go by to look back and say, okay, the neutral interest rate was here or something of that kind of idea. But there is idea of predicting the neutral interest rate. And that's through something that the Federal Reserve calls R star. And now this R star is really an idea of what future inflation expectation is considering the current environment that we are experiencing today. And they have this really long drawn out mathematical formula to figure this all out. Now, one of the people who talks a lot about the neutral interest rate is a gentleman named John Williams. John Williams is the New York Fed president, and he wrote that speech, Monetary Policy for a Low Neutral Interest Rate World. Now, when you go and you look at the article that I leave down in the description, he's pretty much saying that the neutral interest rate hasn't moved much. Now, I have a tendency to not believe John Williams when he says this, mainly because he's out on the mainstream media saying this. And anytime you ever hear the Federal Reserve out there on the corporate media, the mainstream, anything that you're hearing him going out and like making the statement within a news article, that's propaganda. That's part of the credible threat. Like you have to incorporate that into your idea because the credible threat theory is very well at play right now. It gives the perception into the market of what it is that people are feeling that the Federal Reserve is going to do. And it's that credible threat is done through the mainstream media. So anytime you ever hear the Federal Reserve talking on a mainstream media, what you are hearing is straight up propaganda. And there's no other way to look at it because they pretty much say this is what they're going to do. Now, there is a difference between the forward guidance where the Federal Reserve says, hey, we are going to be cutting interest rates, every quarter for the next, 6 quarters, or, they do some sort of statement like that. That's forward guidance. That is trying to get the market to go ahead and price in what it is that the Federal Reserve is going to do. But when they leave it open-ended like they are right now, we could, we may not. If things change, we could actually raise rates. We plan on doing it later on in the future. This is really what's coming from the Federal Reserve. Think about it. At the moment that everybody is convinced that the Federal Reserve is going to lower rates, what happens to the mortgage market, right? Mortgages start coming down, right? When the Federal Reserve makes this statement, dot plot map came out and they were definitely planning on dropping 13 points, or whatever, 13 interest rates drops this year, some, crazy number. No, it didn't even happen. And then they said it was going to happen at the next meeting or the meeting after that. And now they don't even know, possibly in June. Nobody knows exactly where the interest rates are going to be cut because that's the way the Federal Reserve is maintaining the credible threat. If they straight up told you, then you would start pricing it in right now. They don't want that. They want to be nimble within the economy right now in order to make sure that they keep that maintained credible threat going. And that's by constantly coming out saying they're going to raise them, they're going to drop them, they're going to raise them, they're going to drop them, and all this mass media attention to it keeps the people very confused on the whole matter. So ultimately, what it comes down to is how restrictive is the Federal Reserve's monetary policy to the economy right now. And that's really what a lot of people are looking at the Fed funds rate saying, oh, they're way high. This is causing a lot of damage to the economy. But then they don't incorporate the neutral interest rate. Now, that neutral interest rate is the rate in which that the Fed funds rate is neither accommodating nor restricting the economy. It's neutral, right? And now this neutral interest rate, again, nobody can see it, but they know that it's below what the Fed funds rate is right now, which is making the economy restricted, right? But they don't know exactly how far above that neutral interest rate we are, or below how far the Fed funds rate is above the neutral interest rate. So when you go and you look at the article and you look at what Larry Summers has to say, it was just like the Federal Reserve is just like, they're going to have to raise rates from here, right? The economy is not being restricted at all. The neutral interest rate is somewhere around 4%, which I highly doubt. Like, I don't believe that for a second, you know. But even if it was, and you think about it in that fashion, it would make a lot of sense to why the markets are being juiced the way they are. I mean, everybody's wondering why it is that the stock market's doing so well and why all these other, parts of the economy seem to be doing so well, but yet you have other parts of the economy that are suffering like increasingly bad. Like, look at the freight industry. It's still suffering. I was just reading another article about how some other freight company is declaring, calling out bankruptcy right now. And this is a sign of the products that are moving through the economy. You think about it, we are a consuming based economy, meaning that we have to transact a lot of transactions in order to make business happen here in the United States. We're not the manufacturing base, we're the consumer base. And if those products aren't being shipped, like traveling through freight, through the trucking industry, then they're not going to land to the shelves because they're simply not there in the system. And so this is one of the major problems that we are going to be facing going into the future. And this is one of the things that I have talked about quite a bit here on this channel, was like the idea of a recessionless recession, right? And this is really kind of a weird concept to think of, but really think about what's happening right now. We have unemployment not exceedingly high, like you would anticipate when you're going into a recession. People losing their jobs and the unemployment rising. Right now we have all this layoffs, but yet the unemployment doesn't seem to rise. Not like you would anticipate. Well, this is something that we had discussed a while back, and that the incredibly tight labor market, all the shortages of jobs, all the people who were looking to find wait staff and all the other stuff at the restaurants and couldn't find anybody. Well, all these people who are getting fired from their zombie corporations and getting laid off from there, I'm going to go find work at the service industry. Not a great job, but it's a job. And that's the point about it, is that's the reason why the unemployment isn't rising like you would anticipate, is because this is the issue that is now happening, going from the high paying, awesome job that probably shouldn't have existed in the first place and taking the job over at the service industry like they don't want because it's service industry work and, it's not as classy as having some $100,000 a year job, right? Although maybe some servers actually make $100,000 a year depending on where you live. However, that's the reason why you're not seeing that massive uptick in unemployment. And now, if you don't see the uptick in unemployment, then really you don't feel the recession like you would have typically anticipated when you do lose your job and you can't pay your bills and you start going, into debt and foreclosed on or whatever happens from it. We're not experiencing that in a massive scale. That would be that sign of a recession. And then the bailing out of the corporations, this was probably one of the biggest ones, right? Is that the bailing out of the corporations happened during the pandemic. And even if you think about it right now, right now, the banks, or when you have a situation in which that the idea that the Federal Reserve is going to be lowering interest rates, what that means is that the bond prices are going to go up. Now, if the bond prices are going to go up, speculation from the investors start looking at that bond market thinking, okay, if this is true, that the interest rates are going to fall and the bonds are going to go up, then I can buy bonds right now with the idea that the interest rates are going to fall, the bonds prices are go up, and I could sell my bonds into the future. This is a speculation. They're not necessarily looking at the return on the yield, which is actually pretty high. The speculation aspect of it is that if interest rates come down, then the bond prices go up, I can sell that bond going into the future. And on top of it, the yields are high right now. So the return on this is actually pretty good. So the risk of it, although high on the yield portion of it, the idea of the yield or the bond prices going up in the future then offset that risk, bringing investment going into these corporations. Does that make kind of sense, right? Even though we're in a risky environment, the idea that the Fed is going to be lowering interest rates takes that risk kind of off the table. High yields, bond prices go up, speculation starts to move into corporate debt. So now the corporations are getting funding for this, right? This is like, you can't even make this stuff up, right? This is how it's going down. So again, like what has taken place here within the economy itself is really not what a lot of people would have anticipated coming from the idea of like a recession caused by the higher interest rates. Well, if that neutral interest rate is rising because of the future inflation expectations, then that restriction on the economy becomes less, right? Which then is not as impactful to the recessionary pressures. Does that kind of make sense on it all? Anyway, that's how I kind of feel it's going down. We're 10 minutes into it. Perfect. That's enough information for everybody. Bunches of links down in the description. Let's go ahead and talk about some of these comments that are coming through. Thank you all for being here. All right. Hey, Simon. Good morning, Simon. Hi. Comes from, what is that? Market Shift Player. All right. Crypto Beauty. Hello, everyone. Kevin, it's great to see you, buddy. Good afternoon from Lakeland, Florida. All right. Delove, GM, good morning. Good morning, all-nighter. All right, Brody, all-nighter, good morning. All right, all-nighter says, hi, Brody. Brody says, I mean all-nighter. All right. All-nighter says, hey, Crypto Beauty. New pick, nice. Okay. Brody says, excuse me. Crypto Beauty says, hider, good morning. All right. Go girl, help, I'm stuck in Portland, Oregon. Yikes. Oh, well, yeah, it's not that bad, right? I mean, you kind of get used to it. Hey, they're going to make drugs illegal again. Did you hear that? They're going to criminalize them. At least that's the idea behind it. It's not going to work. I'm just saying. All right, good morning, folks. Just tuned in. All right, good morning, Salty Monkey. Hey, Salty. Good morning. Lots of laughs. Go, girl. I'm in PDX too. All right, calling 8 on the dice. All right. Is there, if there exists a neutral interest rate, it's not if, there is. I mean, nobody knows exactly where it is, all right? Does there exist an absolute ceiling where increasing it higher doesn't restrict the economy? You can't, like, there is no like forcing. I don't think you can force the neutral interest rate. I think the neutral interest rate is just something that occurs that the Federal Reserve can influence I mean, if you can influence higher inflation expectation, you can raise the neutral interest rate, at least in my opinion, giving it some time. But as far as like forcing that to take place, I don't think like, they have a mechanism that says, hey, we need to start dealing with the like, cause using quantitative easing to try and raise the neutral interest rate. Like, I don't think they have a tool like they could use like that. I think the neutral interest rate will raise by the inflation expectations of the people and then giving it some time depending on how big that inflation expectation is. And I believe that would raise the neutral interest rate. But as far as like a tool or a mechanism to make it happen, I don't think the Federal Reserve has that. I think they just have to interact with that neutral interest rate as best they can. And that's one of the reasons why they, had such a problem. I mean, if you go back and you read that speech, Monetary Policy for a Low Neutral Interest Rate World, that speech was just talking completely about the neutral interest rate and how much of a problem it is. But let's continue on here. Ceiling with increasing higher rates doesn't restrict the economy appreciably more. What about the other side, absolute floor? And that's where I'm kind of getting at. Like, the Federal Reserve runs into a monetary policy restriction at the lower bound of zero. And that's what we've experienced over the last few years. The last couple of years since they've raised interest rates, okay, they haven't really had to deal with the zero bound, right? The lower bound of zero. But the previous decade, it was nothing but. Like, they were completely restricted on monetary policy by the lower bound of zero, meaning they couldn't drop interest rates enough to stimulate the economy. Like, if they were up at 15% on the Fed funds rate, they got all kinds of monetary policy that they can work with. They could sit there and just like drop interest rates 5, no problem, stimulate the economy, and off to the races it goes. But now when they hit the zero bound, right, of lowering interest rates, it doesn't impact the economy enough. And then the major problem with it is that the return on capital investment, this is a whole other kind of concept that goes along with it. The return on capital investment starts to fall too. right? When you have lower interest rates, that is the return back into the economy. And if that is less than the inflation rate, then what you have is a negative return on capital investment, which means a deflationary scenario is taking place. Now, that's all happening at the lower bound of zero, which is something that they knew was going to take place. The Federal Reserve was scared of that, and they knew it was going to happen 20-something years ago. If you go and read Ben Bernanke's speech talking about deflation and how to prevent it from ever taking place here in the United States, that entire speech is describing all the things that they needed to do to fight inflation, and this is what we have right now, is all those tools in place. So everything that the Federal Reserve is doing right now, that everybody's saying, oh, God, they screwed up and caused this inflation to happen, and they don't know how to control it, this is what they needed to do in order to keep from the deflation from taking place. Like, it's so strange to think about because it's counterintuitive to all the news articles and all the economists out there who are saying that the Federal Reserve is trying to fight inflation. No, they were fighting deflation, and this is the tools that they used to do it, which caused the inflationary scenario that they were totally hoping for. Remember, today we face an altogether different set of problems stemming from a very low neutral interest rate. That is, the short-term real interest rate consistent with an economy operating at its potential alongside low and stable inflation. Ironically, the problem we need to solve these days is the risk of inflation that is persistently too low rather than too high. The Fed is like nailing it. Like, I mean, I'm not trying to give them like props or anything else. I mean, end the Fed, I don't care. But the considering this speech that was given like almost 5 years ago, 4 or 5 years ago now, I mean, it is like not a surprise to me, all this stuff that they are doing with their monetary policy. And considering like how very few economists out there, how very few people, even on YouTube or anywhere else, considers the neutral interest rate, like at all. Like they don't even know that it exists, you know? And it's like one of the major factors that has taken place within their monetary policy. And there's no way of even looking at it. You can't even go to a chart and say, here it is. Right. So if you're not like following the Federal Reserve and what it is that they are saying within their speeches themselves, then you're probably going to end up missing it. Like that's one of the reasons why I even do the member only live streams, is to make sure that we can concentrate that idea into just a handful of speeches and videos that really dictate what it is that's taking place within the monetary policy right now. And it's very important that, you know, the discussion takes place with around those particular speeches. In fact, we're going to do one tomorrow. I was going to do one on the neutral interest rate, but I thought this video would do better for the live stream, considering that more people can come into it. But tomorrow, probably after Lumberjack Landlord does his live stream, I'm going to do another one breaking down a recent speech given by, I think it was Adriana Kugler, if I got the name right. I'm pretty sure that's her last name, Kugler. Anyway, she did one talking about disinflation here in the United States or within the economy and how it's different this time. I forget exactly what the title was, but I was reading through it, and man, does it not describe the recessionless recession to a T. And still, the Federal Reserve fails to understand that the supply was not going to come back. Like they thought for sure that supply was going to come back and help them out and just like everything was going to be hunky-dory. I have a very hard time believing that they actually thought that, but yet it's still stated within this speech. Right? I know even that one's a little bit confusing for people, but ultimately when the Federal Reserve started raising rates, trying to bring the consuming down in order to bring it in line with the supply, they were hoping to get supply side help, right? Meaning that more supply was going to come to the market from all the shortages causing inflation, right? Consuming comes down, supply comes up. We find that equilibrium, right? Well, the problem with that is that why would manufacturing, supply, distribution want to invest into a consumer that's going to be hurt, right? They're not going to invest into that. They're going to pull back on their investment, which is not going to bring new supply to the market. And we're seeing that actually take place within the freight market. I mean, if there was freight to haul, then they would be hauling it. They wouldn't be going out of business, right? But there's no freight to haul because supply is not coming back in a meaningful way. Not like the Federal Reserve was anticipating it was going to. Anyway, we're going to break that speech down in a live stream tomorrow, but it's going to be a members only live stream. There's links down in the description for it. It's $1 a month to join the live stream. There's all kinds of other videos that you can go back and watch, including one Boy, I'm just really rambling, aren't I? Another one that we had just recently covered, which I think is really important, is talking about the Basel Endgame and what it is that Michelle Bowman was thinking, who is another voting member of the FOMC, very influential. And she had broken down the idea of tailoring, right? Tailoring these new banking regulations to be more able to incorporate into the international banking system, but they want all these banks to be like under the same like regulations, and the Federal Reserve saying, hell no, we can't do that. Some of these banks cannot possibly take on these regulations in the same fashion as what they are trying to push. And so she was like saying, hey, we need to tailor these things in a particular fashion. And that speech was a great explanation of what it is that the Federal Reserve, or I feel the Federal Reserve, is wanting from the Basel Endgame. And anybody who doesn't even understand what the Basel Endgame, I suggest you go and join the channel and go and find that video and watch it, because it was very informative, and you're going to hear a lot of discussion on that coming into the future. All right, moving on. Propaganda, yep, morning, afternoon, ambiguities. It's funny. Here's another thing. I don't know if you're watching right now, but somebody sent me a package to my job, and it was a very significant package, and I want to thank you. So if you're watching, thank you for the gift, for the support for the channel and everything. It was quite incredible. I'm gonna keep it anonymous right now until I find out who exactly sent it, but wow, man, thank you. All right, moving on. Hey guys, we'll catch the replay. All righty, putz, we'll see ya. It's just math. That's okay. 4 plus 4, I meant 8 putz. Okay. The new real-time SOM rule. Yeah, recession indicator released yesterday is 0.27. What was the level that indicated a recession again? Much love. You know what? I'd have to go back and look at that. I thought that was a very, very interesting theory behind behind that particular indicator. And to be honest with you, I really need to go back and read it again, so I just don't give off some false information as far as what the numbers were and stuff. But that's a really good one. I think that's probably something that we should cover here in another video. And I'll do I'll get some research done on that and do a good video on that. 1 trillion in debt being added every 100 days. You know how many times I have heard this? This is so crazy, Ty. I don't mean to like call you out on this thing, but this is something that I have heard so many times now. Like in the comments section, it must be like a little chatter thing that's going on out there, because it seems to be so common of a statement that I've heard. Like, you know what? I understand that it's a lot, and I understand that it's probably very impactful to a lot of people, especially when they're trying to incorporate the idea of how like vast this debt really is. And I do get it that it is going to be very damaging going into the future. But what really, really surprises me about it is this common, like, almost like the common statement that I'm hearing so many times, like over and over and over again. And when I hear that, it's like, to me, that is a propaganda that is being pushed out there. It's like a narrative that they want the people to know about. It's, you know, like money printer go burr, prices go up, right? Same thing. It's just like, you know, I hear this thing constantly going on out there, and it makes me wonder what it is that's being pushed to try and get people to believe a particular thing for a particular reason, you know? When I see that, I have to step back, I have to look, and it's just like, there's something else going on here, you know? So green. Okay, I'm cruising. Okay, railroad industry seems to be taking business from the trucking industry. How is the economy going where you are? I want to buy a car, still very long wait times for a new car. Why? I don't know. I don't know. I live in kind of more of an affluent area. It wasn't always this way. It wasn't this way when I grew up. It was a very working class town, fishermen, loggers, stuff like that. Now it's more trendy and like remote workers. Hospital district is growing huge. We have a huge hospital district here in Astoria now. So things are different. Like the people, the desires, like the bars themselves, like just the things that they want for their lives are so much different than when I was growing up. Like Astoria used to be full of dive bars. Like it was like a hard place, you know. It was, and over the years, it's like now it's all trendy places. Even the dive bars are kind of trendy, you know, and like it's so different from what I remember when I was a kid or when I first, you know, started hanging out in the bars and stuff. They are like all very like, you know, very different from what they used to be. Anyway, so the economy here is like expensive. The house prices, like, I mean, they are stupid expensive around here, like way more than I feel that they should be. But because there's a limitation of them and so many people here with money now, the prices of them are just, you know, much higher than they should be. All right, do you have legs? The body twist looks impossible. I'm leaning on a